Those are the only names fighting for the bulls right now. TCS, Wipro, Infosys. TCS is doing very, very well. 2.5% up, perhaps expecting this exuberance in terms of large deals to rub off on the Indian space as well. Tech Mahindra is also up about 0.5%. Bharti Airtel, which has prepaid a large chunk of its spectrum dues over, I think, 3,000 crores. That stock's reacting well as well for the time being. But then the list completely fizzles out. Don't have too many other gainers to speak of. Banks are flat. ICICI Bank, SBI, IndusInd, they're all at the flat line, unable to make up their minds. If you look at the downside of the screen, there's some profit taking coming in on some of the auto names like Eicher, Tata Motors on the lower side, Maruti slightly lower as well. And Reliance is down about 0.5%, which actually brings me to the downside of the screen. L&T, ITC exerting lots of downside weight over here. No excitement in the metal names, global-facing names like Tata Steel. Hindalco also I saw starting off negative. And then nothing's really adding up. Consumers down about, a couple of percentage points. HUL, for instance, lower. Tata Consumer on the lower side. So very quiet on the Nifty. Now it's a 50-point dip, by the way. So 23,900 is in question. Remember, the 200-day moving average comes in around 23,815, 816 thereabouts. So looks like the bulls want to test that. 50 points lower now.
Well, that's right. Let's run you through a few stocks that are doing well. IKS, the stock is up close to around 5%. So had a good listing. It's building on to those gains. You have BGR Energy. That stock as well is up, moving from circuit to circuit. So that's higher. Sagility, we had that initiating coverage report. So that stock, in fact, is buzzing in today's trading session. It's building onto those gains, up close to around 5% as we speak. MobiKwik, yesterday it corrected close to around 7% from the high point of the day. Today it's got back to its winning ways. Exide, on that news that Sudarshan told us earlier today, which is a positive read-through, that stock as well is moving us. AGS Transact, one of those underperformers, that's bouncing back in trade today on very high volumes. And Greaves Cotton's the other one that's holding mildly in the green. What's not doing too well? PC Jewelers coming for profit taking, down 5%. RBL Bank coming out of the FNO ban, well, that one in fact is down close to around 1%. Just one word, keep an eye out on Zomato today because the Sensex and the FTSE rejig is scheduled for today. So towards the end of the trading session, I think that's another stock that you should be keeping on your radar for the day because of that rejig. You have a note coming in from Nuvama that says that's a stock to track for today's trade. Otherwise, more or less, flattish to a mildly negative start. And just one more stock, Granules India. I recall on the day you had that negative news flow, the stock had corrected from around 620 to 520. After that, it went into the FNO ban. And we were saying that it's a high probability that the shorts could get stuck into the system. Take a look at what's happened. From 520, 530, the stock has bounced back and made up all of those losses. That's the power sometimes of short covering, of the shorts getting squeezed out on the wrong side. So after that sharp decline, it's recovered almost all of those losses. So keep an eye out on that one. Prashant.
Absolutely. And, lots of names moving around. By the way, in the index, we got about a 40-odd point cut. Just a few more stocks here. IKS, the listing is from yesterday, listed with a 40% gain, is the top volume-led gainer by far. It's up another 5%. There's MobiKwik. MobiKwik was day before yesterday's listing. Saw some, I think, it came off the highs yesterday, started higher, but 3% higher, big volumes. Sagility is at number 3, volume-led gains, 4% again. So 45, there's that Jeffries note, but stocks basically doubled from when it hit the market. And now, of course, there's this initiation coming. So be mindful of that. Exide, of course, Sud's been talking about. Amar Raja, I think we've highlighted. I highlighted Avalon in the morning with Mitesh, Avalon and Centum with, I think, Siddharth. Avalon is up 7%. Was a big mover yesterday, and there's momentum here, 1,062, and it's got volumes to boot. Look at 63 Moons. 63 Moons, it's not on another circuit, let me put it that way. It's moved up from $450 to 2 months back to 1,000 plus, and it's up 3%. Look, about 100,000 shares in terms of volumes as well. Samman Capital, the erstwhile Indiabulls Housing Finance, is up 2.5%. And I can go down the list, but that's it. I mean, in terms of if you wanted to do a volume cutoff on these gainers, that's it. Sai Life is down 1%. I just want to take a quick look at Vishal Megamart as well, which is a listing from day before yesterday. Vishal, of course, hit a 50,000 crore market cap, came to the market at 35,000 crore market cap. 50,000 yesterday ended lower, and it's about 106 odd rupees, 107 odd rupees. It's up about 7 million shares right now.
Just adding one or two more consumer names that are making a move. Swiggy is on the move now. 3% up. Volumes are also picking up on this counter. There's Pratap Snacks, which is interesting this morning. 13% up on Pratap Snacks. And I saw, Liberty shoes cross by. Liberty is interesting. One or two sessions is just from nowhere. It started to move higher, and this morning as well, there's some green on Liberty shoes, 6% up.
So on Pratap Snacks, Stallion Asset, yesterday they bought close to 3.7 lakh shares in the company. I think that's something that's excited the street, and that's why that stock is up. Volumes as well rather high. I think 2.5 lakh shares, we'd never see that. In an entire day, I think it does close to around 5 lakh shares or thereabouts. So very high volumes. That could be one of the triggers why it's moved up.
Absolutely, and we'll have more on this. A little later on the program. Our market master of the day is Vineet Sambre, Head of Equities, DSP Mutual Fund. He's joining us now. Vineet, good to have you with us here. Good morning. Thank you very much. Is the primary market activity keeping you busy, Vineet?
Not really.
Or the secondary market? No? You're not on the anchor prowl?
No. So actually, if you just look at the participation, we have been very selective as compared to the street, and it is to do really with the kind of market levels, valuations. So I think it's better to be on safe side than look at all of them.
No, absolutely, but it's crazy, right? I mean, the rush to get anchor allotment. I mean, the rule this week has been 40% listing gains. I mean, almost like a done thing.
No, but see, I think while it is all going good, but still, I mean, there is a lot of euphoria. I mean, people are there's a mad rush. So I would say it is also linked a lot to, how people are actually looking at, like you mentioned, anchor demand. So I think that is leading to a lot of this exuberance. But I think, at some point, a lot of the money will also move out from the secondary market to primary market, and then it will have its own bearing on the overall market. Then I think one has to be more, as I said, more rational and picky about where you are investing.
I mean, the primary market has been hot. And by the way, I want to say, and we'll put the story out later. We broke the story late evening yesterday that Flipkart, the big e-commerce player, is now also looking at an IPO. I mean, it's on the road to IPO. So if you thought 2024 was busy, I think 2025 is going to be equally, if not more busy. It's a lot of stuff lined up, which will hit the primary market going forward as well. Vineet, I must say, though, a lot of interesting business models, right? I mean, expensive, not, etc. is different. But look at Sagility, IKS. We don't have those kind of listed peers in that sense, right? Which are making it to the market. Today, we are speaking with a hotel company, but that's, of course, lots of listed players now. Somebody in the auto transmission space again, but a lot of newer business models also over the last 1 or 2 months, which have made it to the market.
No, I think this is a very valid point, Prashant, and this is what we also are very excited generally about, because India's growth is really looking very broad-based, and like you mentioned, new models have come. Few years back, we had the largest EMS company or the outsourced manufacturing company coming up with the IPO. We had also participated, and today it is a large cap company. It has crossed 1 lakh crore in terms of market capitalization. So I think there are very valuable pieces of business which are actually coming up in terms of new issuances. There are new areas to look at, and I think from that perspective, India as a country, it is also leading to a lot of de-risking and also making the mid and small cap, let's say, more relevant from a participation perspective as compared to large cap. Because in general, I think people have been worried about the mid and small caps as well because of valuation, which is right. But in a way, there are so many segments where otherwise you can't participate via large cap. So I think you're right. These are interesting times. Over a course of a full cycle, maybe some of this business will truly create great value. Some may fizzle out, but which is where I think we need to sort of differentiate between the men and the boys, actually.
Glad you brought up that point, Vineet. Hi, good morning, Surabhi here. Great to have you on the show. Because I was looking just at that data in terms of performance. I mean, the stark outperformance of the mid-cap space, right? 33% in this year versus 10% on the Nifty. Even in December, the Nifty is down 1%. The mid-cap index is up 5%. And individual mid-caps have done much, much better. So now, to separate the men from the boys, so let's talk about some of the themes where you still see a reasonable valuation comfort, reasonable growth comfort. Find those pockets for us. At least sort of name them out. EMS, consumer technology names like Swiggy, etc. Just name some areas where you still have comfort of taking a fresh investment call.
So before I talk about the sectors, let me say that at a very high level, the way we are thinking today is in terms of the absolute valuations. I don't see great margin of safety across all the sectors broadly. But where we are trying to seek margin of safety maybe is in the business cycles or, like you mentioned, visibility of growth. So I would say that one big theme which we believe should sort of come back would be the rural theme. Because after a long period of 1-2 years of underperformance, we are seeing that because of the welfare spends which are happening, or the rural income generally has been okay. I think that's one theme which one should sort of think about. Now there are various pockets within the rural and the semi-urban. Maybe one can look at largely. So that is one area we are looking at. So within that, maybe consumer, both discretionary, non-discretionary, is the way to play. There has been a lot of building material, the real estate which has got sold, and building material sector has still not shown the kind of upsides or the growth momentum, which we believe should happen at some point in time. And that is an area where I think we will see better visibility of growth, and which is where we are sort of looking at. The other segments are the ones which we have been anyways positive over long period of time. Healthcare, because that is a category which sustainably keeps growing as far as the domestic market is concerned at 11 to 12% and doesn't shock you a lot. And depending upon how their international businesses pan out, should do well. IT sector, I feel quite positive on the IT sector. There are a lot of headwinds which are coming up in terms of the AI shift and all of that, but I still believe that the sector has a potential to deliver good returns over a period of time. So I think these are maybe few segments which I can recall are sort of at least showing better visibility of growth, and it's okay to be part of that.
Select IT stocks will do well as well. Hi, Vineet. Good morning and good to see you. Vineet, since we're almost at the end of 2024, which has been a decent year, even with the recent, dizziness that we're seeing in the markets, the first 10 months were rather good. 2025, what is your expectations on the headline index? It's expected to be a difficult year, so that's why I ask you that. Should we be satisfied with some kind of a consolidation? Do you think that we could have a big down year? And also, this year was a year of mid and small caps. Next year, do you think it's going to be a year for large caps?
So I think, Nigel, very important question. And the way to think about the market is that it follows the earnings growth. And last 2-3 years has been very high in terms of the earnings growth. We have CAGR at over 20% plus. And now suddenly we are staring at low single digit kind of earnings. Maybe September quarter was the first quarter of a very low earnings. And I think this low earnings momentum looks like sustaining for a quarter or two, because even the confidence is not yet back when we are talking to companies for the December quarter. So I would imagine that we are starting on a very cautious note, and maybe the market there's a room for consolidation, some correction over the course of the next at least first half. And post that, maybe depending upon how the growth metrics pick up, like I said, I'm positive on the rural side of the consumption. That should add, maybe government spends also start picking up. And a low base formation towards the March quarter should mean that starting the second half of calendar year 25, we should start seeing some direction which the market would pick up in terms of growth. So to me, I think growth remains the most important aspect, fundamental aspect. It can take care of many problems as such, and till the time that returns, I won't see market scaling new highs is my assessment.
Vineet, this maybe is the last interaction for 24 and we look ahead into 25 and beyond. Any one kind of micro theme where fast growing area where one can still find something reasonable out there? Of course, we can't talk stocks, but I'd love to. But what would that be? One space.
Sure. So Prashant, within the lending space, we are going through a bit of a stressful time. And in general, I think NBFCs have played a very good role as far as growth is concerned and good quality of assets is concerned. I'm assuming that the stress currently which we are seeing should spread and maybe over the course of next 1 or 2 quarters before we start seeing base formation there. I would be really interested to look at some of the excellent NBFCs within different pockets, maybe CVs or other personal finance and all of those. where I believe that if the stress leads to correction in that space, that's one space which can provide good returns over cycle. So I think we'll have to live through this difficult period for 1 or 2 quarters where you will get good opportunities. Is my assessment.
Got it. All right, Vinay. Thanks a lot for your words of advice with regard to the outlook as well as on current positioning of the markets. Wishing you all the best for the remainder of this year, Vinay, and looking forward to chat up with you in 2025.
Surely, happy New Year, all of you. Thanks. Bye.
Happy New Year, Vinay. Well, time to move on then. Poly Medicare, that's a stock in focus. I'll tell you what, in this year, we talk about being a good year. The stock has given you returns of more than 75% in 2024 so far. IFL Securities, they in their recent report suggest that the Indian medical devices industry is expected to clock 11 to 12% CAGR over the next few years. Discuss the opportunity, what it means for the company. We're joined by Mr. Himanshu Baid, the Managing Director at Poly Medicare. Hi, Mr. Baid. Good morning, and thanks a lot for joining in. I recall a couple of Christmases ago where I called you up and I said, I want to understand the opportunity. And you said, Nigel, the opportunity is very, very large. And then, in fact, we further got into the business. And from there, I think your stock price has moved up 3 or 3.5 times or thereabouts. The opportunity, though, is something that the street is excited about. Valuations, you can argue that maybe the stock is not very cheap. But let's focus on the opportunity first. The Chinese medical devices exports, well, they are clocking around 75 to around $100 billion odd. India, I think, is at $4 to $5 billion. How do you see exports moving ahead with regard to the industry panning out? And also, Trump is coming into power in 2025. It's supposed to present an opportunity to India versus China. Tell us more.
So thank you, Nigel, for inviting me. Good morning to everyone. So I think, India, if you see 2-3 years ago, exports out of India were just around $2 billion. So in 3 years, we have seen it growing from $2 to $4 billion. And subsequently, the import growth has kind of de-accelerating. So there is a huge opportunity because of this PLI scheme which came in, regulations and, new medtech parks. So a lot of medtech manufacturing is now happening in the country. So as we speak, more than 3,000 medical device licenses have been given for companies to manufacture products in India since the industry was regulated. So it's a big uptake, in manufacturing in the country. And I see exports growing maybe around 15 to 20% CAGR for next 5 to 6 years because a lot of manufacturing has started. And I think there's going to be a ripple effect for local market as well as for export markets. Now, coming to the new administration in the US, I think, they will look at China very closely. And I think there's some tariffs coming on Chinese products already. Some have been announced and some are going to come maybe in course of time. If India gets reciprocal tariffs, even if it comes, I think the custom duties in India is pretty low right now on import of medical devices. It's between 7.5 to 10%. So I don't think even if Indian products are taxed in US, it's not going to be very high. So I think we have a lot of potential going forward. We're already working very hard on this, getting more FDA approvals. We started working on this US business a couple of years ago. So I think now, we are seeing some, new contracts been thrown to us. So I think we are very bullish about US in coming years.
Okay.
And I'm pretty sure that more outsourcing will come to India in next few years.
Just to follow up then, from $4 billion approximately, as you said, we have doubled in the last 3 years. By 2028, should we be in that vicinity of around $10 to $12 billion for the industry? Is that a possibility? Point number one. And for you, Mr. Baid, I think in the coming year, you're guiding for $2 to $3 million of US revenues, right? But the opportunity is large. So in the similar time span, next 4 years, what should this number look like for you?
See, Nigel, if you remember, we talked last year about it and, I guided for $15-20 million initially. But I think now we are looking at a much larger number. Probably we could hit between $20-30 million, looking at the new opportunities which we see in front of us right now. So definitely the number is going to change. But let's say next few months, we're going to have more clarity on that.
And the industry goes to 10 billion in the next 10 to 12 billion. Should that be a fair estimate?
Bullish. I'm pretty bullish about it.
Got it.
Okay, well, so lots and lots of room to grow, really, right? I mean, in that sense. Good morning, Mr. Baid. Prashant here. And Nigel, we were talking about the number of X's it's grown, right? I was just looking at the price chart. It's up 10 times in the last 4 years. 10x.
Phenomenal.
10 bagger, literally. So, Mr. Baid, So yeah, I mean, opportunity is big. Since we're talking very basic, fundamental sort of things here, let me ask you two very basic things. One is, an industry, medtech as an industry, for an outsider, it would seem like India is the big market, right? Because it's like import substitution. Because most of the machine, you go to any hospital, most of the medtech, the equipment, at least the high-end equipment is all, either it's a Johnson or it's a Siemens or it's a what have you. So that's the technology part of it. Consumables, the gloves and the this and that, the syringes, all those, of course. I think but that's at the lower end. So just give us a sense. Is India the big market? What should investors really have their what should the focus be? How fast the Indian market is growing, or really, this export opportunity? Go on.
So if you look at Indian imports last year were around $8 billion across different categories of products. So in my view, this import is going to come down to maybe, let's say, next 4 or 5 years to around 4 to 5 billion. And that is going to be substituted by local manufacturing. And as we see, local manufacturing is already picking up. And plus, whoever is manufacturing locally, and if the technology is high-end, let's say, in terms of manufacturing, I think the exports market open up simultaneously. And that's the reason. So there will be a double whammy impact, that imports will go down, exports will increase. So almost we will see $8 to $10 billion of new manufacturing happening in India and for export markets in the next 5 to 6 years. So that is where I see industry. And in fact, we have been discussing this with the government. And government is also pretty much, in tandem with the numbers we are talking about. Okay.
And this would be, the export part, right? It's largely to the developed market. Is that going to be, I'm not talking about Poly Medicare, but the medtech industry here, the Indian industry, not MNCs making here, but the Indian homegrown companies. Will that be on the consumable side? Or do you see it moving higher end, high tech as well, technology driven, which are of course going to be higher value and margin accretive?
So basically, India is still at low to medium end of the technology. And I think when you look at India is not 1.4 billion people. And I think India is a much more bigger market because Africa, Middle East, Southeast Asia, Latin America is all serviced by India now. And if we have similar, let's say, technology products coming out of India to those markets, I think that is a huge opportunity for Indian companies out there to address these markets. And other than that, of course, developed markets are there, Europe and US, which are, going to take its own time. But these are, let's say, easy wins and sure wins, in near future. And I think India is still in the low to medium tech. But if you look at companies like, bigger companies like Siemens, GE, Philips, they have all set up manufacturing facilities in India. So all of them are now exporting out of India to at least 40, 50 countries. So that play area is also increasing in the high-tech space also.
Mr. Baid, hi. So now we've discussed the opportunity, we've discussed what India is doing, what the industry is doing. Let's come to specifics now. For Poly Medicare, you've been guiding for about a 24% growth rate. Margins have been fairly healthy at 27%. You also, I think, mentioned on a recent analyst call that you're looking at technology tie-ups with perhaps larger global medtech brands. So where is that whole contract manufacturing opportunity? Where are you on those conversations? When should we expect something to come through? And an outlook on margins, whether you can improve them even higher from the current 27%.
See, I think we'll continue the guidance for 22 to 24% for rest of the year. So we are very, optimistic about that. You've already seen first 6 months, we have been close to that number already. And I think on the contract manufacturing side, I think things are, looking quite bullish right now. So we have been talking to a few players right now. And hopefully in the next few months, and I think the change in government in the US, I think the larger contract manufacturing opportunities out of the US right now. So I think as things, pan out in the US in the next few months, we will see a lot of action out there. So it's a wait and watch situation, but we are fully, aligned with that, and we are working on that. And we are looking also at other opportunities, whether we can, look at more technology outside of India and look at acquisitions. So that is also another area we are focusing. But again, there's nothing concrete, but as soon as something comes up, definitely, we will let you know.
Okay, so just a quick follow-up to this. Two things. You said two things. One, that you should be announcing something on the contract manufacturing side in the next 2-3 months. It could be with a US company or a tie-up with a US company. Now, typically, how does it work? This obviously opens up a large revenue opportunity, but generally, is this business a slightly lower margin business, or does it retain the very high margin profile? Because you're at 27% now.
See, I think margin would depend on the product category, and definitely. So for us, we are not the cheapest manufacturer in the world. So definitely, that is very clear. So and we definitely would look at margins first also when we look at new opportunities. So I think we'll balance it out. So we are very clear that we'll continue to work on similar margin profile in coming years also.
Okay, Mr. Baid, very quickly before we let you go, last year you did around 1,400 crores and you're guiding for 20-25% growth. At peak levels, what kind of revenues can you do since you're doing some capex? And Mr. Baid, every time you join us, you tease us that there's going to be some inorganic growth. When? Before the end of this fiscal, will we hear something?
I'm not sure, Nigel, about the inorganic part, but definitely, see, it's always a work in progress. You continue to look at new opportunities, and you will have to look at it's always a build versus buy situation for Polymed, because we are a hardcore manufacturing company. So we'll have to look at that from a technology perspective, and we'll continue to look out. But on the growth side, Nigel, I think as we are doing some heavy capex in coming years, so the revenue will keep on. Of course, our target is to achieve a 20% growth over the next 3-4 years, and that's the number we will guide for in next coming years.
Mr. Baid, I was actually going to ask you why doesn't Poly Medicare make for, say, a GE or a whatever, one of these larger medical equipment companies here? So when you say a contract manufacturing sort of tie-up in the next couple of months, we should think on those lines?
So we are more on the consumable side, Prashant. So, for us, the play area is more consumable side. And that is also a very big part of the industry, whether it's in India, outside India, or in the US. So I think our focus area would be more on the consumable side.
And just one thing, that $8 billion market which you spoke about over the next 4-5 years, right?
Yeah.
How much of that value you think will come from Indian companies making in India, and how much from MNCs making in India?
I think I would say 50%.
Okay, about 4 billion from Indian homegrown companies, and the other from MNCs making out of India, but of course, selling here and elsewhere. Thank you very much. It's a great conversation, Mr. Baid. Appreciate you coming on and talking to us here. And we'll speak again in the new one. Well, we'll take a quick commercial break here, and we're going to come back with the next company. So this is a hotel company, actually I should say a developer, which is in the hospitality sort of business. We have Ashish Mota of Blackstone joining in for that conversation. Stay tuned.
Welcome back. Well, the markets have seen a good bounce from the day's low. We had highlighted this, right, earlier today, that don't rule out a bounce from the lows. Yes, the picture is looking very, very gloomy, and that's been the case, actually. So sustaining of this bounce is important. If I'm looking at a level, I think 24,120, that's the near-term technical resistance. The higher resistance will come at the 24,400, which incidentally is the 20 DMA. So keep an eye out on that. A good recovery, though, from the low point of the day. Let's address a few stocks, though, that are moving around. Sudarshan's here to revise what's going on with Exide and Amara Raja. Sudarshan, take it away.
So both the battery companies are higher in trade. Exide is currently higher by 2% and Amara Raja is also trading with a gain of almost 1%. First, talking about the Exide, company in April 2024 had signed non-binding agreement with Hyundai and Kia to supply battery cells and battery packs. Now the update is now company Exide has signed term sheet with Hyundai and Kia. And what does this term sheet do? Basically, it helps now Hyundai and Kia to onboard Exide as the supplier for both battery cells and battery packs. Now, this agreement is between Exide's electric mobility arm and Hyundai and Kia. And so far, Exide has invested more than rupees 3,000 crore in its electric mobility arm. Now, coming to Amara Raja, company will supply absorbent glass matte battery technology to Hyundai, and basically already company has the procurement agreement with Hyundai for the same technology, and Hyundai is likely to use this AGM technology for its upcoming electric vehicle, and that is likely to be, because company has not disclosed, but I assume it might be Creta EV, because that's the EV that Hyundai is looking to launch in Q4 of FY25. So that's the reason both Exide and Amara Raja are in focus.
Okay, all right, got it. Thank you very much for that, Sudarshan. By the way, look at the market. It seems Santa Claus is finally coming to town, or so the bulls would want to at least hope, because suddenly from about a 50-point dip at the open, now the market's up 81 points. That's quite a recovery. And it's cutting across sectoral lines: Titan, NTPC, Dr. Reddy's, Adani Enterprises, Bajaj Finance, Trent, Hero Motor, you name it. It's up and away.
Hopefully Santa stays in town though, Yeah. Hopefully it doesn't exit stage left, because we need to sustain at high levels. Just putting that point on board.
No, absolutely. And also, I think a lot of people have been hoping that finally these FPIs, they will finally go on their Christmas and New Year holiday, so they can at least stop selling. But we have to take that with a pinch of salt as well, because typically when volumes start thinning out, you can see outsized moves. But for what it's worth, it's a nice pullback by the market. The Bank Nifty now is the only main index which is in negative territory. Mid caps and large caps doing well otherwise. Markshi is with us. She's tracking a couple of other stocks that have actually held out nicely in positive territory. GE Vernova, I think, on orders, and BASF, which is spinning off a part of its business and looking to list it separately. Makshi, tell us more.
Well, absolutely, Surbi. First up, GE Vernova, the stock will be in focus, and that is because they've announced a few order wins. They've received orders worth over 400 crores from Sterile Grid for supply of high voltage equipment, and some analysts estimate that the company is sitting on a backlog of almost 10,000 crores, and this backlog has come in despite winning no HVDC orders. So that's a big positive for this company. They've also won some orders in the past as well, and therefore we're seeing that up move on this counter. But apart from that, BASF is the next counter we're watching out for, and that is because the company has announced that the board has given its in-principle approval for demerger of its agriculture solutions business into a separate listed legal entity. Now, this in turn will enable operational flexibility, leverage differentiated steering, and create value for the shareholders of the company. Keep in mind that this particular part of the business accounted for nearly 14.5% of the FY24 revenues at 2,006 crores, and this move is in line with what the company had announced back in September. Back then, they had said that globally BASF SE will complete legal and ERP separation of agri solutions business by 2027. So this is a step in that direction, and therefore the stock is seeing an up move today.
Okay, all right. Vamakshi, thanks very much for putting that on our radar as well. So BASF doing really well in trade today. But it is the primary market that's been dominating the attention, and you've been hearing us, of course, get into a lot of conversations to understand these new businesses which are coming to the street. So let's get another one going. Ventive Hospitality's 1,600 crore rupee IPO is opening out today. The price band is 610 to 643 rupees a share, and the company is going to be using a large part of this fundraise, almost 1,400 crores, to repay debt. Ashish Mota, Managing Director and Head of the Real Estate Acquisition at Blackstone, backed by Ventive Hospitality, is with us now. Ashish, great to have you on. Thanks for joining in. And I must tell you, this is a breath of fresh air, because usually I think 80% of the IPOs, if not more, that are coming to the market are all OFSs, right? But you are actually raising the cash. It will go for the use of the company. And a large part of this is going to be for retiring debt. So let's start there. How much debt will you be left with? I think you have a little over 3,000 crores on the books. What is the debt equity level that you're comfortable with? And once you pay off this debt, how much will your finance cost go down by? And what is your borrowing rate? I'm just curious. At what rates do you borrow right now?
No, thanks, Urbi, and good morning. So, honestly, we're using, like you said, most of our proceeds to deleverage at post paying down the debt. We will be less than 10% LTVs. Our debt cost should be in the zip code of about 100 to 120 crores. Average interest cost being about 9% odd. So the idea is, honestly, to use all of these excess proceeds, the capital structure flexibility that we'll build in, to acquire assets, to grow our balance sheet both organically and inorganically. So that's the idea about future growth for Ventive.
Okay, but so while you're paring down all this debt, you're also adding capacity. You'll be moving from, I think, about 2,030 odd keys to, I think, a little over 2,400. That's your target over the next couple of years. So how is, have you accounted for the funding for this? And just give us a sense of the revenue as well as you keep adding more and more rooms.
So, honestly, today Ventive is already cash positive. We have about close to 900 crores of EBITDA, translates to a large amount of cash. And the idea is to fund the current pipeline, which is about 370 keys, entirely through internal proceeds. So, we will not use or we will not need any external debt to finance the existing pipeline of assets that we have.
Ashish, hi, good morning. Prashant here. Would Blackstone sort of be in the company over the next couple of years, at least 4 or 5 years?
Yes.
Or
yes, Prashant, clearly. So, honestly, we are very excited about the hospitality sector, both globally and in India as well. And the idea is to benefit from the growth that we can see over the next few years. So, as you see, neither Panchsheel nor us is selling anything at the IPO, and the idea is to continue to remain and see some of this growth over the next few years.
so no sales for 3 years, 4 years, at least?
I wouldn't say that. We are fund structures and we will sell down, over time. But I think we believe in the long-term potential of the platform. And, we'll continue to sort of invest more capital, invest into new hotels to sort of grow this. And therefore, we think we'll be here for the longer term.
So out of those 2,000 odd keys, it's largely split between, the majority is, I think, Maldives, right? And the rest is
Pune.
No,
Pune and Bangalore.
It's actually 1,500. It's about 1,500 keys in India, Prashant. It's about 500 keys in the Maldives. The idea about Ventive, honestly, was to target the aspiring Indian business and leisure traveler. So I think that's the segments that we're sort of focused on. We are focused on the upper upscale and luxury segments, where we think we'll derive the most profitability. And therefore, we will continue to sort of grow and expand in these. If you look at the development pipeline that we have, Varanasi, again, a big tourist hotspot. Spiritual tourism is sort of catching on in a big way. I think that's why we're building a Marriott. We are focused on the key office markets. Bangalore is something that we're expanding on. Pune, we have a large presence. And we'll continue to grow in some of these markets going forward.
Ashish, just one thing. So the company is a developer, right? And then you get on these, the JW and the Ritz, etc., to manage the hotels. So the company pays a fee.
Correct.
And that is in what vicinity and how will that?
Prashant, it's broadly about 6% of top line. That's the zip code on which, and just given the scale that we operate on, we typically tend to get the better end of some of these contracts as compared to standalone operators. So, Marriott's a large partner with us, but, we are pretty brand agnostic. We have Hilton, Raya, Minor, most of these guys as partners on some of our hotel properties.
Just want to tell you, Nigel, I had the good fortune on a business trip of staying at the Ritz-Carlton, Pune. I would have to say, one of the best experiences that I've had. So, Ashish, please pass on my compliments to the team. Absolutely fabulous. And I think that is the class that you're targeting, right? The business traveler, aspirational leisure. So, yeah.
Absolutely.
Just thought I'll put that on the table.
Indeed, Ashish, we've been happy travelers, happy customers. So that's great news. And thanks a lot for that, for playing a role in that. But, the big question is going to be, what about the shareholders? So let's get back to that then. You're going to be retiring close to around 1,400 crores of debt. You'll save close to around 200 crores of interest, as you told us earlier. What is the balance sheet going to look like post that, post this debt repayment? Will you still have some debt? If yes, how much would it be? And since there's going to be a swing of 200 crores, now you'll turn PAT positive, right?
Yeah, so a couple of things on that. Our debt will go down to about 1,500 crores. We have about 3,000 crores of net debt today. It'll go down to 1,500 crores. in doing that, will release a lot of capacity for us to grow. So I think that's our key focus, to continue to sort of grow this platform going forward. And that's what we see in terms of the capital structure.
Okay. So, just to talk about some levels, if you can kind of leave us with the occupancy for the first half, I think was about 61 odd %. The average room rate is about 16,645. Just kind of a bit of a peek into the future, because anyway, the second half is very, very strong. This quarter is very, very strong for the industry as a whole. But the ARRs that we see, you yourself were touching, I think, close to 20,000, right? This is as of FY24. Do you see these levels of 20,000 sustainable? And, as you yourself glance into the next calendar year and the next fiscal year, what do you see on occupancies and ARRs across your properties?
So, without getting into the specifics in terms of, numbers and projections, but just, you said it right, Zurbi. I think the second half is obviously very good in the entire hospitality sector, but it's also, fairly skewed in the Maldives. So, the last 6 months of the year typically get about 70 to 75% of the revenue in. So we expect a very strong third and fourth quarter, both across India and the Maldives. Just to give you a sense, in terms of ARR breakups, we are at about close to about 11,000 rupees in India, about 70,000 or about $850 in the Maldives. And we dominate, both the peer sets in India and in the Maldives across our properties. So what we're seeing in terms of bookings, very strong across both India and Maldives. So we expect both occupancies and ARRs to sort of keep ticking up.
Got that. By the way, Ashish, we speak with hotel companies all the time, and we had the Sami Hotels management. We speak with Indian Hotels management quite regularly, and generally, I mean, the expectation is that the cycle is going to be on and is going to remain good because of supply-demand dynamics. Being favorable over the next many years. So I think you're in a good place. Thank you very much for joining us, and looking forward to many more conversations as the company makes it.
Thanks a lot. Thanks for the time.
Thank you very much. Okay, all right. That's the new hotel company, which is, the issue is opening today. So another very interesting company, and this is a MNC that we're talking about, but in the auto ancillary space, Carraro India is open for public subscription today. It's an Italian company. It's a 100% owned sort of MNC, and it's a complete OFS by Carraro International, the Italian entity, in the Indian entity. So they've raised about 375 crores from the anchor investors already. We have David Grossi, a Chief Financial Officer and whole-time Director, and Balaji Gopalan, Managing Director at Carraro India, are joining in to take some questions. Gentlemen, great to have both of you here. Thank you very much for your time. Prashant, this side. Balaji, if I can start with you, the money that is being raised, I mean, first up, a basic question, what is it going to be it's a complete OFS, so it goes to the parent, right? What's the basic underlying motivation to do this? It's an Italian MNC making it to the Indian bourses. First thoughts, Balaji.
Yes, thank you very much. Very good morning to all of you. Thank you for giving us this opportunity. We are very excited about what is going to happen now. It's a new chapter in the history and legacy of Carraro Group and Carraro India. We will be the first country or the subsidiary of Carraro Group to get listed outside Italy, and it's a very proud moment for us. And we are very thankful to the Indian market and the environment here, which is encouraging the shareholders to look at India in a big way. The reason why we are going in for this IPO is Carraro is a technology company. We provide differentiated solutions for the transmission industry in agriculture and construction vehicles. And we have consolidated ourselves in the last 3 decades, and we are seeing a very clear movement that is happening from the two-wheel drive technology to a higher technology in tractors and introduction of specialized vehicles in the construction sector. And this is where Carraro has the legacy of 90 years of presence in global geographies and aware of the global soil conditions. So we are able to provide our OEMs, our customers, with the right product solution and the right technology that is required in India, mainly in agriculture, because food security has become a big
Balaji,
concern.
if I can, allow me to come in. No, that's very well put. I mean, just a basic introduction. So let's just talk about tractors, right? Which is the primary, the big sort of revenue stream for you. And as you said, you're in the four-wheel segment within tractors.
Yes.
Just break it down for our viewers. The market size right now. How many tractors? I think a little over 10 lakh tractors are sold every year in the country.
Yes.
How many are four-wheel, which is where you are operating in?
Yes.
How fast is that segment growing? As a percentage of the cost of the tractor, the transmission that you provide, the transmission gear that you provide, what is that in value terms? And how is that growing? Go on.
Got it. So as you rightly pointed out, the Indian tractor market is roughly 1 million, 10 lakhs. And today, the penetration or the migration from two-wheel drive to four-wheel drive has reached roughly between 16 to 18% as per market research. And this growth absorption is happening quite fast, I would say, because if we take a data of about 6 years back, it would hardly be 2-3%. So in the last 5 years or so, there has been an uptake and absorption of this four-wheel drive technology. And what is more important for all the investors and for you as well is to understand that globally in developed countries like US and European Union, the four-wheel drive market is upward of 96-97%. So India is still at a very latent stage in absorbing this, and we have a long way to go. And to answer your question specifically, currently the four-wheel drive market has reached roughly about 17%, number one.
Okay.
Number two, your question about what is the
value.
The differential, I think, in the pricing is what you were asking.
The value.
Two-wheel drive.
No. The value. In the four-wheel segment, how much does a tractor cost, and what is the value that you provide? I mean, the kit, the transmission gear.
We are a mission-critical supplier because our products which go into the tractor constitute between 20 to 30% of the cost of the vehicle. So if you take a 10 lakh rupee tractor, which is roughly a 50 horsepower tractor, a four-wheel drive versus a two-wheel drive, the differential should be between anywhere around 70,000 to 90,000, 95,000, depending on which configuration of the four-wheel drive you will be using. So that is the price range that is the differential between two-wheel drive and four-wheel drive.
All right. Hi, gentlemen. Good morning and good to see you, Ben. This is Nigel on this side. Since it's an entire OFS, I'll want to understand what is the current capacity utilization levels you are functioning at. I think you are doing roughly around 1,800 crores of revenues. So what is the utilization levels? What is the debt in your books? And how do you all fund the further expansion from here on? 3 numbers.
Okay. Coming first to the utilization, our plant utilization currently is between 82 to 85%, considering the gear plant and our assembly plant. And in an industry that we are working on, this kind of capacity is sufficient to cater to our needs because we need to also keep a buffer. So I would say we are more or less quite well utilized and quite efficient in our operations, and any further increase in our revenues will require some amount of investment to happen.
Okay, all
and
right.
Pertaining to the financial aspect, I would double click on David Gulick to David Grossi to please come in.
Coming across to you, David, take it.
Yeah, of course. So in terms of debt, today we have a net financial position of roughly 100 crores, 10 to 12 million euro, and a debt equity ratio which is lower than 0.5x. So we believe a level of debt which is
Okay, all right. So we got that 100 crores odd
Is
is
the
what you're
future
telling
growth?
us. Yeah.
Sorry?
Yeah, please go ahead. The line just snapped there. Please go ahead.
Okay. In terms of future growth, future expansion, according to our plans, whatever will come in the future as of now is manageable with our internal accruals, with our internal cash flow generation. So we do not see, we didn't see any need to, maintain part of the proceeds here in India.
So this is 100 crores of net debt as of now. You're functioning at around 82% capacity utilization levels. Just one more point I wanted to understand. What is the asset turn for y'all? If you'll put in 100 crores, how much of revenues can you generate?
Usually twice as much.
Twice.
Two
Got it.
and a
And
half.
just one more question. Since it's you have an international parent, as of now, I understand there is no royalty that is paid. Is that correct?
We pay a small royalty, which is for the brand utilization.
Okay. What is that amount, sir?
We pay a small royalty to our parents for utilization of the Carraro name. It's a brand royalty.
Okay. What is the percentage? The current percentage? What percent of revenues do you all pay as royalty?
I think there is a line disconnect between you and
Balaji, why don't you take it?
Yeah.
What's the royalty percentage?
See, there are two royalties. One is the product royalty, engineering royalty, which is zero because they have transferred 153 IPs already into Carraro India. Hence, we don't have to pay any royalty for the product. However, in the past and in the present and future as well, we have to pay a small brand royalty, which is roughly between 0.3% to 0.4%.
Okay, and on this product royalty, which is zero, earlier there was an amount, but currently it is zero. Any plans of restarting the product royalty, or it will not come back? Because post-listing, your shareholders will want to understand what is the vision with regard to this royalty. So any plans on restarting the product royalty, and on the brand royalty, will it stay in this vicinity of around 0.3%, or is there an upside risk?
No, first of all, answering the brand royalty, which is applicable, it will remain in that zone. We have never gone beyond that decimal of 0.3 or 0.4, and it will continue. Historically, it has been the same. Now, coming to the other question of whether the product royalty, engineering royalty can kick in again, and there is a reversal, I would like to assure you, not just as an assurance, but the very fact that 153 IPs have already been transferred and bought by Carraro India, there is no question of paying any royalty to anybody because the IP is now owned by Carraro India.
All right, now got that. David, just one last question to you. So the international the parent is selling shares to Indian investors. Will this be it for now, or should we expect more sales, or no plans as of now?
As of now, no plan. This is the range of dilution that we were planning. But of course, now we are diluting around 30%. Which means that we keep a door open for the future. Never say never, but as of now, this is not the plan.
Okay, that sounded like you said keep the door open, but no immediate plans. Nothing has been discussed.
No.
In any case, let me come in here. It's important to understand that Carraro is a global company and it wants to penetrate into India and make India one of the largest operations of Carraro Group. So keeping that in mind, we have strengthened our operations over here. So the concept of dilution is not there in the horizon as of now. But what Mr. Davide meant was you can't say no to something, but it's just a hypothetical situation that something can happen in future. But as of now, in the next couple of years in the business plan, we have no such plans of getting into further dilution in the market.
All right, Balaji, thank you very much.
Consolidate and grow. Yeah.
Thank you very much for joining us, Balaji. David, thank you very much for joining us. Great chat. We had more questions, but out of time, and we'll continue and pick up on this when you make it to the market in terms of the listing itself. So the IPO, of course, opening today. So that's the primary market action. But look at the secondary market.
All over the
place.
place.
There is a dive and how. At 9:42, the Nifty was at about 24,054. And now we're at 23,812. 810. So we're at the day's lowest point. That 100 point now seems like a flash in the pan. Is gone, and you're essentially where the GIFT Nifty was indicating the open, about 100 odd points down at this point.
And Prashant, this is also the point that now we're at that zone of testing the 200 DMA. To be fair, the Nifty in the earlier part of the correction has dipped below the 200 DMA, but then it managed to recover from there. When I'm just going to go back for the sake of reference and talk about those lows, we're still far, far from them. These are the lows in November that I'm talking about, late November. The low at that point was 23,263. Thereabouts.
That's a support survey.
So, yeah, so we were still a distance from those levels, but yeah, the sell-off has been quite furious and has been very, very choppy. In fact, after the break, I think we'll have Mitesh join back in and take us through some of the ideas. Just want to point out that the Bank Nifty is leading the decline. It's down about a whole 1% at this point in time, and mid-caps, they've also now given up. Mid-caps for the better part of this week have managed to continue moving higher, irrespective of the large cap move. But now the advanced decline ratio is negative, and the mid-cap index is also down 0.6%. More on the markets in just a bit. Welcome back. The next company on our radar is JSW Infra. Now, the stock has been a good performer in this year, 2024, up almost 50%. The company recently announced its longer-term, medium-term vision in terms of how much capacity they're looking to add, what their plans are. In fact, their capex is going to be 30,000 crores from FY25 all the way up to FY30. So let's talk about this vision in some more detail. We have Lalit Singhvi, Chief Financial Officer at JSW Infra, joining in. Mr. Singhvi, great to have you on. Season's greetings to you. So let's start right there with this guidance that you've given that your cargo handling capacity is going to be 400, MTPA by FY30, and you'll be putting 30,000 crore rupees to work in this expansion. How will you fund it? What are the current debt and cash levels? And what's the plan?
Good morning, and first, thank you for having me on your shows. So this expansion plan, what we have announced is, taking our capacity from 170 millions to 400 million tons, and this will entail 30,000 crores of rupees. So as far as funding is concerned, we have a very robust operating cash flows. So if you see our cash flows last year was also 1,800 crores rupees, and next 6 years, and a lot of capacity additions will keep coming up every year. So with this cash flows, and there will be one equity dilution also. As per the regulator's requirement, we have to dilute our equity from 85.6% to 75%, and that has to happen, before October 26. So that is going to happen, and balance sheet is very robust. Right now, till September, you can see that we are net debt free. So partly we will need debt in between. So with these all three, combination of sources, we are very comfortable to fund our growth plans.
So, sir, just let me dive a little deeper in the mix that you pointed out. You said you're generating 1,800 crores of cash. The business is throwing up that kind of cash annually. You will also need to sell some equity because of regulatory reasons. So let's discuss that first, and then we'll get to the borrowings. So you need to lower, the promoters will have to lower the stake by almost, roughly 9%. How much will anything happen in FY25? Yeah. How much in FY26? And where are the plans with respect to this equity placement?
Yeah, so, going by the, during IPO also promoters have not, sold their shares. So it is more likely to be a primary issuance. So money will come into the company. And right now we don't need money because we are sitting on cash. So we will be doing probably, before the regulator's deadline. So immediately we don't need to fund that. And if you do the back calculation for bringing 85.6 to 75, we need to dilute 14% of the current base. So it's quite a big chunk, and there is a very good appetite from the investors because right now the floating stock is low. So we will decide whether to go in one stroke only, the entire thing, just before the timelines, because currently we don't need any requirement.
Mr. Singhvi, hi, good morning. Prashant here. One of the things I've heard from investors, and this is, investors and analysts who track the companies, that, you're in a space, JSW is a very large group, a conglomerate, but you also have a competitor which is very large and which is kind of, at least on the port side, has some of the best assets which are already taken. You, of course, you're more on the terminal side, not so much on ports and greenfield ports, etc. So I just wanted you to respond to that. And out of this you will go from 170 to 400, right? This 230 million tons that you will add, how much of this is going to be fresh acquisitions in terms of how much what you modeled, and how much will be increasing capacity of assets you already have?
Sure. So, say from 170 to 400, which is 230 million tons. So, out of that, 50 million tons would be the brownfield. So, we have our ports like Dharamtar, Jaigarh, and Goa and Mangalore terminal. There we are adding the capacity. So, around 50 million tons would be the brownfield capacity additions, and 130 million tons would be from greenfield. So this greenfield includes, we have already announced, like one is Murbe, which is very near to Mumbai. Another is Kenny, which is in Karnataka. And the third one is Jatadhar, which is Odisha. So there are large projects coming in, all put together close to 100 million tons of capacity we are adding. And 50 million, the remaining 50 million tons is, is in the pipeline. So we will be announcing as and when, we have approvals in place. So this is the total 400 million tons. And, our business model, if you compare with others, they may be largely on the private side, but we find, the combination of terminals and greenfield ports, which are the private ports, that works well for us. Because in case of terminals, CapExes are low because all the ecosystem is provided by the port trust, like dredging and, breakwater, evacuation system. So CapExes are very low, turnaround is very fast. So I look at it like ROC. So ROC from the terminal comes much better. So if you look at our ROC versus the greenfield heavy ports, you will see the difference.
Yeah, no, absolutely. And I remember having this conversation during the time of the IPO as well. So out of the 230 addition by FY30, sorry, you said brownfield is 50, rest is greenfield. Rest everything is greenfield. Is that, did I get the numbers right?
Yeah. So 50 is the brownfield, rest everything will be greenfield. Yes.
Rest everything will be greenfield. Got it. Any inorganic, sort of further inorganic acquisition, etc. we should hear from you in 2025?
So, this 400 tons doesn't include what we, bid through the, in the privatization process of the government. Like last year, we won 2 bids. One is in JNPT, another in Tuticorin. So government keep coming up with the, privatization process and few terminals every year it's coming. So there we will be bidding aggressively. But that quantity we cannot share now because we don't know how much quantity will come and how much we will be able to win. But we stand to a very good chance, as you know that there are only 2 pan-India basis players and one is not very keen on the terminal side, as you just said. So we stand a very good chance to win those things. So as and when it comes, there are 2-3 in pipeline we are hearing. But as and when it comes, we'll be bidding it aggressively and add to this, and this will be on top of 400 million tons.
Mr. Singhvi, just a quick final question, just to go back on the capex. You said that there will be some element of debt that you will take on. What is the debt equity that you are that you will be comfortable holding to fund this 30,000 crores?
We have given guidance in terms of net debt to EBITDA, which is 2.5. But we don't foresee that we will be touching anytime soon that 2.5 thing, because our cash flows will remain robust, and by 27-28, 118 million ton capacity will come into force, effect, and that will be giving again cash flows. So, but that is the guidance. What we have given is 2.5. All right.
Got that. Thank you very much, Mr. Singhvi, for joining us and sharing all those details with us, with our viewers. Really appreciate it. And we are wishing you and your team a very good 2025 as well. Always good speaking with you here on the channel. I think we're going to take a quick commercial break here. Market's down 40 points, so there is a recovery. From the last time we saw, there is a 100-point recovery, which is already set in. So very volatile. See you on the other side.
Welcome back. You're with us on Bazaar, and what we are looking at is a very, very volatile equity market. From a big fall of almost 140 points, now there's a bit of a recovery, back almost in the green, again in the red. Extremely choppy day on equities. But what's happening with commodities? Let's go across to Manisha and find out. Manisha, happy Friday to you. What's the latest?
Well, I'm looking at the iron ore prices, which are headed for negative 2024. If you look at the prices in China, they have declined by 21%, and the US prices are down by almost 23% at this point in time. If you look at the chart or the report card for 2024, well, we started the year on a higher note at $144 a ton. We did see a decline at around $90 a ton as well. Currently, the iron ore prices are holding it out at 104. Well, there have been various reasons for the decline in prices. The major one comes in from steel, which also has seen a price decline. And because iron ore is a major ingredient in steel and the demand was lower from China because of the construction sector going down and the steel prices declining 17% in China and down by 38% for HRC in US, that led to decline in iron ore as well. Apart from that, it also is about the ongoing economic uncertainty when it comes to demand. There is lack of detailed policy from China in sense of fiscal spending for 2025. The markets also are looking at China on whether or not we would see better numbers coming in, because China is the largest consumer when it comes to iron ore. There also is higher production numbers coming in from major producers like BHP, Vale, Fortesque, and of course Rio Tinto. So we are looking at higher supplies, higher inventories, and that has led to pressure coming for prices. The markets also have seen increase in exports from Brazil and Australia. That has been weighing on as well. So 2025 pretty much could be a surplus year when it comes to iron ore there. The output has been increasing and the worsening demand, and that is what is weighing on. Talk about the outlook for 2025, and most of the banks and brokerages are talking about lower prices here. The best of the numbers, that is $100, comes in from BMI Fitch, but other banks like Bank of America, Goldman Sachs and ING are talking about prices anywhere between 80 to 95 on the lower side from this year for 2025.
All right, Manisha, thank you very much for that. Keep a close eye on those commodities. Markets are volatile. We're down just 40 points, but I have to say market breadth is firmly down 2:1 in favor of the number of stocks which are declining. It's goodbye from all of us here on Bazaar. Thank you very much for staying with us. More coming up on the other side.